Investing successfully doesn't hinge on an extraordinary IQ, privileged information, or even luck. What truly matters is a robust intellectual framework for decision-making, coupled with the discipline to prevent emotions from disrupting it. In his seminal work, The Intelligent Investor, Benjamin Graham offers such a framework, replete with reasoning that aids in emotion management. His investment approach is renowned for its efficacy over the past century. The remarkable achievements of not only Graham himself, but also of his many followers, are notable. Among these followers, Warren Buffett stands out remarkably. As of this video's creation, Buffett is the third richest individual globally. He famously dubbed this book the best book on investing ever written. In this video, I aim to share what I believe are the most valuable insights from Graham's book. Insight number 1: Understanding Mr. Market. Picture owning a portion of a business that cost you $1,000. Every day, an unpredictable character named Mr. Market visits you, suggesting a value for your share and offering to buy or sell shares at that price. However, Mr. Market's valuations can be wildly inaccurate. For example, in March 2000, he valued your share at $2,600, but by March 2001, he believed it to be worth only $500, despite a 50% increase in company revenue and a 20% rise in profits. Should you trust such a fickle evaluator to determine your investment's worth? Certainly not. Graham emphasizes that a stock is more than just a symbol with a price, it represents a stake in a business. And Mr. Market's irrationality often leads to discrepancies between a business's real value and the price he's willing to pay. Sometimes, he's overly optimistic or excessively pessimistic. Graham's advice is to invest only if you are prepared to hold on to a stock, irrespective of the price fluctuations Mr. Market shows you. But for a level-headed investor, Mr. Market's whims can present lucrative opportunities. You're not obliged to trade with him, he simply provides you with options. When his price is unreasonably high, it's a chance to sell. When it's a bargain, it's an opportunity to buy. It's worth noting that when Graham wrote his book, people weren't bombarded with constant news, forecasts, and stock quotes like today. In the 1970s, Mr. Market's visit was a once-a-day event with the morning newspaper. Now, he's vying for our attention every time we check our phones, which for many of us, is incessantly. But more frequent visits from Mr. Market don't mean we should trade more often. If his offer doesn't meet your criteria, simply ignore it and continue with your day. Insight number 2: Strategies for the defensive investor. Benjamin Graham identifies two investor types: the defensive, or passive, investor and the enterprising, or active, investor. Most are better suited as defensive investors, limited by the time they can allocate to investing. A defensive investor should balance their portfolio, ideally with a 50-50 split between stocks and bonds. This ratio, however, should align with your personal circumstances and the prevailing yields of stocks and bonds. It's crucial to rebalance this allocation annually or biannually. For example, if stocks rise to 60% of your portfolio, rebalance by selling some stocks and buying bonds until you return to the 50-50 equilibrium. Regularly invest a set sum, perhaps right after receiving your paycheck. This strategy, known as dollar cost averaging, ensures a fair average price over time for stocks and bonds and prevents mistimed market entries. For the stock portion, the defensive investor should: 1. Diversify across 10 to 30 companies, avoiding heavy concentration in any single industry. 2. Choose large companies, defined by Graham as those with over $100 million in annual sales, around $700 million today, adjusting for inflation. 3. Seek companies with strong financial health, indicated by a current ratio of at least 200%. 4. Select companies with a consistent dividend record, having paid dividends for at least 20 years. 5. Look for companies without any earnings deficit in the last decade. 6. Aim for companies with a minimum 33% earnings growth over the past 10 years, equating to about 2.9% annually. 7. Ensure you're not overpaying. The stock price should not exceed 1.5 times its net asset value. 8. Avoid overpriced earnings. Keep the price-to-earnings ratio below 15, based on the last 12 months' earnings. Alternatively, consider investing in an index fund, which typically mirrors the market's average returns. Insight number 3: The enterprising investor's path. While it seems straightforward for a defensive investor to achieve average market returns, outperforming the market as an enterprising investor is far more challenging. It demands patience, discipline, a willingness to learn, and considerable time. Many professional and private investors aren't cut out for this role. The temptation to react to Mr. Market's fluctuating price quotations is often stronger than one might expect. Consider the misguided statements from top investment strategists during the dot-com bubble's peak in the early 2000s, which led many investors astray. The key takeaway is that company profits have limits, so the price an informed investor pays should be finite as well. Price matters immensely for the enterprising investor. The market often overvalues fast-growing or otherwise appealing companies and undervalues those with less impressive trajectories. Intelligent investors should generally avoid growth stocks, as they rely heavily on speculative future earnings rather than current valuations. However, if you find a company valued lower than its net working capital, you essentially get its fixed assets, like buildings and machinery, for free. Such opportunities were lucrative during Graham's career but are rare today, except in severe bear markets. Graham also proposes a more flexible set of criteria for enterprising investors, allowing for consideration of a broader range of companies. Unlike defensive investors, there's no strict rule on company size, and while diversification is advised, the number of holdings isn't fixed. In-depth analysis of a company's annual financial reports is crucial for the enterprising investor. Graham's book, The Interpretation of Financial Statements, delves into this topic, which we'll explore in another video. Insight number 4, the crucial margin of safety. One unavoidable risk in investing is the possibility of error. However, you can significantly reduce this risk by always insisting on a margin of safety in every investment. This concept is vital. Often, a company's price doesn't reflect its true value. A sufficient margin of safety is achieved when the investment price is no more than 2/3 of its assessed value. Imagine building a ship designed for 30 Vikings, but sinks with 31 on board. It's a clear lack of safety margin. Similarly, buying a stock you estimate to be worth $31 when it's priced at $30 offers no real safety buffer. An error in your estimation could lead to significant financial setbacks or, in our analogy, some very unhappy Vikings. The margin of safety principle is crucial. It's about ensuring a buffer zone to protect against inaccuracies in your valuation. A formula presented in the book helps to gauge a company's value and determine if it can be purchased with a margin of safety. The formula is value equals current, normal, earnings times 8.5 plus 2 times expected annual growth rate. The growth rate should reflect the anticipated yearly increase in earnings for the next 7 to 10 years. Let's look at an example, analyzing the 3 largest companies in the S&P 500 as of September 2018 with this formula. Interestingly, you can also use the formula in reverse to determine the growth necessary to justify current stock prices. Here, we see a significant disparity. For instance, Amazon's stock price implies an expected annual growth rate of 74%, whereas Apple suggests a more modest 5.8% growth. Is such a discrepancy reasonable? This highlights the importance of a margin of safety and the need to critically evaluate growth expectations against stock prices. Insight number 5, the uncoupling of risk and reward. Contrary to popular academic belief, which posits that expected returns should match the level of risk undertaken, Graham offers a different perspective. In academia, risk is often measured by the volatility of investment returns. Graham, however, disagrees with this notion. He suggests that the disconnect between price and value in assets means that returns are more closely tied to the effort and skill an investor applies in finding undervalued assets. Consequently, a defensive investor who adopts a more passive approach may expect minimal returns, whereas an enterprising investor who applies maximum intelligence and skill could reap higher rewards. Imagine a scenario to illustrate this point. It's 4 a.m. in Moscow, and after a night out, you find yourself in a dubious part of town. In a shady bar, a man offers a game of Russian roulette for $10,000 with 1 bullet in the revolver, a 16.7% risk. Then he ups the ante to $100,000 for 2 shots, increasing the risk to 33.3%. This mirrors the academic view of demanding higher rewards for greater risks. However, investing in the stock market doesn't necessarily follow this pattern. Remember, price and value in stocks are distinct. Purchasing a company at 60 cents on the dollar presents both a great potential reward and a low risk. Even better, finding a company available at 40 cents on the dollar means a higher potential reward with even lower risk. It defies logic to argue that buying at 40 cents is riskier than at 60 cents simply because the reward is greater. Let's quickly recap our 5 takeaways. 1. The market swings between over-optimism and excessive pessimism. Use this to your advantage rather than letting it sway your valuation of assets. 2. Defensive investors should opt for a diversified portfolio of stocks and bonds, focusing on undervalued stocks. 3. Enterprising investors should also seek stocks priced below their intrinsic value, especially those trading below their net working capital. 4. Always insist on a margin of safety in any investment. 5. Lastly, risk and reward do not always move in tandem. What are your thoughts on Graham's principles? Do they hold up in today's investing landscape as they did back in the 1970s? I'd love to hear your views in the comments below. Also, if you have any books on investing, personal finance, or money management you'd like me to summarize, drop a suggestion. And if there's a particular takeaway you want me to expand on, feel free to comment. Thank you for watching.